Employee benefits are a major expense for public sector entities, covering salaries, healthcare, and pensions. Accurate accounting for these costs is crucial for transparency. Ipsas 39, part of the International Public Sector Accounting Standards, guides how to account for all types of employee benefits. The core idea is the matching principle. Recognize expenses in the period employees provide their service, not when benefits are paid. This approach gives a true picture of an entity's financial obligations. Ipsas 39 covers more than just paychecks. It includes paid leave, pensions, and termination benefits, each with specific rules. Understanding these rules is essential for compliance and sound financial decisions. We'll break down Ipsas 39 into 4 categories: short-term, post-employment, other long-term, and termination benefits. For each, we'll explain what it is, give a simple example, and show the journal entry. This step-by-step approach will make Ipsas 39 practical and approachable. By the end, you'll see that while the details can be complex, the core concepts are logical. Let's get started by looking at the basics of short-term employee benefits. Mastering these principles is key for anyone working in public sector finance. Ready to simplify Ipsas 39? Let's dive in. Here's how it all works in practice. Short-term employee benefits are those settled within 12 months after the reporting period. This includes wages, salaries, paid leave, and bonuses paid within a year. These benefits are simple to account for, no need to discount to present value. The expense is recognized when the employee provides the service, usually monthly. If paid immediately, cash is reduced. If not, a liability is created. For example, if a department pays $100,000 in June salaries, the expense is recognized in June. The journal entry: debit salaries and wages expense $100,000. Credit cash $100,000. If unpaid at period end, credit salaries and wages payable instead. This matches labor costs to the period of service, ensuring accurate financial reporting. It's the most frequent employee benefit transaction. Simple, direct, and essential for transparency. Let's move to post-employment benefits. Next up, pension plans. Post-employment benefits often mean pensions, split into defined contribution and defined benefit plans. Defined contribution plans are straightforward. The entity pays fixed contributions to a fund with no further obligation. The employee bears the investment risk. The entity's expense is the contribution for the period, recognized when the employee earns it. No complex calculations, just match the contribution to the period of service. Example: if a government agency pays 5% of $200,000 in salaries, the monthly contribution is $10,000. The journal entry: debit pension expense $10,000, credit cash $10,000. If unpaid, credit pension contributions payable. Once paid, the entity has no further liability. This method is simple and transparent. Defined contribution plans are easy to manage and report. Now, let's tackle the more complex defined benefit plans. Here's where actuarial calculations come in. Defined benefit plans promise a specific retirement benefit, often based on salary and years of service. The entity bears the investment risk and must ensure enough assets to pay promised benefits. Accounting is complex. Future obligations are estimated using actuarial methods. An actuary calculates the present value of benefits earned this year, service cost, and interest on the existing obligation. For example, if service cost is $500,000 and interest cost is $150,000, total pension expense is $650,000. The journal entry: debit pension expense $650,000, credit net defined benefit liability $650,000. This increases the long-term liability, reflecting the entity's growing obligation. No immediate cash payment, just recognition of the future promise. Defined benefit plans require careful estimation and regular updates. Next, let's look at other long-term employee benefits. Other long-term employee benefits include items like long service leave sabbaticals and long-term disability. These are not settled within 12 months and are accounted for similarly to defined benefit plans, but with simpler rules. The present value of the obligation is estimated and recognized over the employee's service life. All actuarial gains and losses are recognized immediately in profit or loss. Example: a university owes $75,000 for sabbaticals earned this year. The journal entry: debit long-term employee. Benefit expense $75,000. Credit provision for sabbatical. Leave $75,000. This reflects the growing obligation, even if payment is years away. Immediate recognition keeps financial statements accurate. These benefits are less complex than pensions, but still require careful tracking. Now, let's cover termination benefits. Termination benefits are provided when employment ends, not for service rendered. They're recognized as a liability and expense when the entity can't withdraw the offer or when restructuring costs are recognized. If paid within 12 months, treat as short-term, otherwise, discount to present value. Example: a ministry offers $30,000 to each of 20 employees for voluntary redundancy, totaling $600,000. Recognize the full amount as soon as employees accept. Journal entry: debit termination benefits, expense $600,000, credit termination benefits, payable $600,000. When paid, debit the payable and credit cash. This ensures the cost of restructuring is reflected immediately. Termination benefits are recognized in full, not spread over time. Let's summarize Ipsas 39. Ipsas 39 ensures public sector entities recognize employee benefit costs in the right period. Short-term benefits are simple: expense as incurred. Defined contribution plans match contributions to service periods. Defined benefit plans require actuarial estimates and create long-term liabilities. Other long-term benefits are accrued over service life, with immediate recognition of actuarial changes. Termination benefits are recognized in full when committed. Understanding these categories is key for compliance and transparency. Mastering Ipsas 39 is essential for public sector finance professionals. Accurate reporting supports accountability and sound management. Use these principles and examples to build a solid foundation in Ipsas 39.